And we, all right, and we're trying to decide a different approach this year, but good morning. My name is Mark S. Lee, and I'm the founder and president and CEO of the Elite Group, which is an integrated strategic marketing consulting organization. I'm also an adjunct professor at 3 different universities, a radio host, a blogger, and a media contributor here in Detroit. And all the things I do is I primarily focus on small business development, entrepreneurship, strategic planning, and we get overall impact on Detroit's revitalization. And thank you for joining us for the 9th annual Small Business Workshop, which is in fact presented by Fifth Third Bank. And I'm pleased that you're able to join us in this hybrid format. We are here on site at Tech Town, Detroit, but we are pleased that you're able to join for the 4th straight year. And as I just referenced, this event will be hybrid. And again, our speakers, along with myself, will be presenting the workshop from Tech Town, Detroit. We appreciate their support, one of our host sponsors, and our attendees will participate virtually. In fact, let me tell you, this is no longer just Detroit. This is being broadcast across the country. We have people tuning in from across the country. I know, for example, from the city of Pittsburgh and also Chicago, points in between. I've heard from people in Florida. I'm very pleased so that this workshop continues to expand. Again, this event is free. I'm very proud of that. It's free, and without our sponsors, this would not be possible. And I'd like to thank our presenting sponsor, Fifth Third Bank, and they've been with us from the beginning. And we appreciate all that they do here in Detroit and beyond for the support. And a program like this would not be possible without the support of all of our sponsors and partners. Therefore, please let me take a moment to recognize the following sponsors. Already referenced Fifth Third Bank, Detroit Development Fund, Comcast Business, Field Institute, First Independence Bank, Nouveau Cabinets and Countertops, and our host venue, Tech Town, Detroit. Our partners include Michigan Women Forward, Tanner Friedman Strategic Communications, Cindy Fletcher, State Farm Agent, Insurance Agency out of Plymouth, Michigan, as well. And I want to give a special acknowledgement to our good friends from Detroit Public Television. We got great media coverage. I'm really blown away by the media coverage. Thank you, Detroit Public Television. Latino Press, the Detroit Free Press, El Central Hispanic News. I really am pleased to our friends from the Latino Press and El Central gives us a chance to continue to expand into different areas of the city as well. I also want to give a very special thanks to RSVP Premier for coordinating this, the event manager and the event planner, and Cynthia Say, and she's also been taking care of us on site here. Additionally, this event is being recorded and will be available on Detroit Public Television's YouTube channel. At this point, I'd like to welcome our presenting sponsor, Fifth Third Bank, to make a few comments. They've been with us from the beginning. Again, we appreciate all that they do here in Detroit for their ongoing support for this annual workshop. So at this point in time, I'd like to invite Dave Jerdot, Regional President, Fifth Third Bank, Eastern Michigan, to come up and say a few words. Dave?
Thank you, Mark. Good morning. It's actually kind of fun to be in a room again with some people at the same time, and having a group out there over the network is fantastic as well. And what an incredible facility it shows them. Tech Town is a great asset for the city of Detroit. So certainly proud of the things we have going on around us. You know, Fifth Third, it's been a pleasure working with Mark and his group over the last 9 years to present to the small business community. You know, it's been a privilege to be a partner. Small business is so important to Fifth Third Bank. That truly is the engine that drives our economy. It helps drive the economic outputs of the communities where we live and do business and service. You know, we pride ourselves in trying to be a resource around small business. That's why we participate in people like money, provide assets and information that hopefully all of you small business owners can use to your benefit. It's certainly an interesting time, and Mark always chooses his topics appropriately. And, you know, navigating a business during an uncertain economy is probably a good statement for today. And I think you're going to hear from some people that will help provide you insight and information on how to actually handle that situation. Fifth Third's proud to supply some of the speakers today. Our chief marketing strategist, Tom Jellis, joined us. Will provide some good information regarding the economy. Our business banking national sales director, Nadia McLeod, and one of our great business bankers in the community here, Juliana Perry, who I'm always proud to say is one of my teammates. Again, I want to express appreciation to Mark and all the other sponsors and the other people who will be participating in the conference. Thank you for those that have dialed in and are participating. As small business owners, you've weathered a lot over the last few years. I wish we could say each year, no challenges, we're going to be out there, it would be just status quo. But I think that's the benefit of what Mark Lee and this group has put together and what Fifth Third supports is every year brings something different, brings a challenge. And your ability as small business owners to pivot and change direction and adjust in the environment you're doing business is critical to your success, but just as critical to the output that we can get in the economy and the environment where we're doing business here. So, Mark, I want to turn it back over to you. Thank you in advance for a great session and a wonderful partnership over 9 years.
Appreciate it. Thank you so much. Thank you. Again, we appreciate Fifth Third's ongoing support, and we're going to continue to move on. And also from Fifth Third, I would like to introduce Tom Jellis, and who will highlight the state of the economy locally, regionally, nationally, and its potential impact on small business. Now, we've been hearing a lot about the debt ceiling, we've been hearing a lot about inflation. Is there a potential recession on the horizon? These are all things that hopefully I know that Tom will be addressing. If you have questions, please drop them in the chat as well. I also want to say, if we do have local media, please drop that and drop your information in chat as well. And we will certainly address any questions that you may have. So specifically, what is the impact on inflation? What's the impact on the overall economy here in Detroit, across the state of Michigan, as well as across the country? Tom is the chief investment strategist and is responsible for leading the investment management group's asset allocation process, both strategic and tactical, which forms the management of a $40 billion investment portfolio that he has. So at this point, I'd like to do is to take this opportunity to introduce Tom Jellis. Tom?
Thank you. Morning, everyone. It's a delight to be here. We really appreciate the opportunity to have this conversation in front of all of you. Thanks to my Fifth Third partners for the invite in. I am not a Detroit native. I have in-laws in the area, so I'm up here all the time. Love the city. I've seen the city grow for the last 20 years since I've been coming up here. This Tech Town facility is absolutely amazing. If you haven't come to check it out, please do. It's a wonderful transformation that's going on in the city. And Mark, thank you for the invite and the partnership. It's great to finally meet you face to face. We've done a few of these on the radio over the last year or two, so it's wonderful to spend some time with you. So thank you. My name is Tom Jellis. I'm the chief investment strategist at Fifth Third's investment management group. It's a fancy title. All it really means is I am in charge of leading a group of investment professionals. We are charged with making investment recommendations on behalf of our wealth management clients. That's really what my job is. One of our core beliefs, our core tenets is if you identify properly where you are in the business cycle, you will make better investment recommendations. We're big believers that the past is prologue. We've got 90 some odd years of modern financial market and economic history. History tends to move in cycles and in waves. And we can take a lot of what we've learned over the last 90 years, again, in global economies and financial markets to apply to what we're recommending for our clients today. So, hopefully you can see the slides that we're sharing. One of our core beliefs really is, put your message out early. In this message, we're trying to scare you a little bit. We're talking about uncertain times in the economy. We've got this first page, the US economy, are we losing the race? That's meant to kind of wake people up. The economy can be pretty boring. I do a lot of these. I usually lose the audience within the first 3 minutes if we don't kind of wake them up. So we'll wake you up with a little bit of a scare tactic. We're going to talk to you about the positives in the economy. And there's lots of positives in the economy that we need to recognize, but there's also some uncertainties that we want to address in a forthright manner. So we're going to get off to that. I was told a long time ago that when you do these conversations, when you have these talks, don't bury the lead. Give your outlook right on the first slide, right on the first page, and then talk about how you got to that conclusion. So we've got this notion here that we're in a race. The race that we're facing economically in our country is a race against getting rid of inflation. Inflation is the biggest issue that we're facing as an economy today. My guess is you can tell me horror stories about your inputs to your businesses, wage gains for your employees, the cost of going out, the cost of gasoline, the cost of home prices. They've all been going up quite a bit over the last 18 or 24 months. The Federal Reserve has been on a big, there's no other way to put it, rampage to bring down inflation. And the Federal Reserve has, kind of a very blunt tool to bring down inflation, and that's moving interest rates higher. And that's exactly what the Federal Reserve has been doing. We'll talk a lot about these drivers here in the next few slides, and then we'll get to our conclusion. But for right now, our view is that we are going to see a slowdown in the economy over the next 6 to 12 months. That is what happens when we raise interest rates as much as we have over the last 13 to 14 months. As interest rates go higher, the cost of capital goes higher, and then businesses have less of an incentive to borrow and invest. So that activity slows down. And then eventually you'll see earnings and cash flows slow down for these businesses, which kind of leads to a slowdown in the overall economy. So where we sit today with much higher interest rates than we've had really over the last 10 or so years, with inflation that is still a problem, our view is that there's more of a chance that we will see a recession in the next 12 months than not. Qualitatively, we put kind of assign a 60% chance of a recession in the next 12 months. Also means we've got about a 40% chance of getting through this difficult time with just a soft landing. We'll talk a little bit about those, but there is going to be a slowdown in the economy, and we're going to see it over the next 6 months. And it's really anybody's guess at this point how bad it will be. We don't know. One of the humbling aspects of my job is that you don't have definitive answers all of the time. Our crystal ball is cloudy right now, and our view is that for business owners, it's a time to be a little bit cautious, and for investors, it's kind of the same message. And we'll talk a little bit about this as we go through the slides. So we're going to talk about the economy, and then we'll wrap it up, and hopefully we'll have a little time for questions and answers at the very end. All right, so we're going to cheer you up now with some good news slides. There are some really strong aspects of the economy that we really should highlight to offer us hope that we can see a slowdown and no real damaging recession. The slide I'm showing you here is a look at the unemployment rate in our country. We're really good at putting about 1-point font on these PowerPoint slides. I'm not sure you can all see it, but the important thing to kind of pay attention to here is the green line, and that green line is the unemployment rate. And we care deeply about the unemployment rate because we are a consumer-based economy. 70% of the U.S. economy is driven by, people that have jobs, earn wages, and ultimately spend those wages. That's 70% of consumer spending is what drives the economy forward. So what I'm showing you here is all the way to the right is the unemployment rate today is about 3.4%. That is the lowest unemployment rate in the last 50 years. You have to go back to 1969 to get an unemployment rate this low. What it tells us is that people that want jobs have jobs today, and that's really, really a strong starting point for an economy. Again, I only speak for my family, but we're doing our part to keep the economy running forward. Money comes in the house, goes right back out of the house. And typically the U.S. consumer acts very similarly. So when we've got an unemployment rate at about a 50-year low, it tells us that we have a pretty good starting point, that consumer spending is going to remain, it's going to hang in there as long as this job picture hangs in there. Those gray bars on this chart look at the recessions that we've had in our country going back to about 1980. And you can kind of see that this green line kind of goes lower as we get deeper into an economic cycle, kind of bounces around a trough position for weeks, months, and a couple of quarters. Then once it starts ticking up, you typically are on notice. You're going to see a recession at some point in the next 6 to 24 months. So the good news is the job picture today is very, very strong. That is driving our economy, keeping our economy afloat. We certainly believe that today we are not in a recession. We feel very strongly about that. But we also think that with the lowest unemployment rate in 50 years, there's not much more room for improvement. And our expectation is we're probably at what economists would call full employment. And that's a notion where kind of everybody that has a job or wants a job has a job. We don't expect to see much improvement from here in the jobs picture, and it's primarily because we think we're running out of workers, and we'll definitely get into that as we go through the slideshow here today. But for today, this is a good news slide. That green line has not started ticking up. We don't think that a recession is imminent, but we do expect it to be more difficult for business owners to add the payroll because there just aren't enough workers out there to be found. The next piece of good news, yeah, please.
We're not quite sharing yet.
Sure. Perfect. Thank you very much. Let me go back one slide, see if you can see that. That was our unemployment rate slide. So the lowest unemployment rate in 50 years, again, really good news for the economy today based on our consumer spending type based economy. And you can kind of see this in this squiggly page we've got here. Again, you know, one of the superpowers we have is we put a bunch of spaghetti strings on a page to obfuscate facts and confuse our clients. This slide absolutely does that. We're trying to show here is another look at the jobs picture. That red line indicates the number of jobs that our economy has added since January of 2022. So the last 14, 15 months, our economy has added about 5.5 million jobs. That's really, really, really important. All those other squiggly lines indicate the last 11 times our country has gone into a recession. And you can kind of see that horizontal at 0. Eventually, during recessions, you see those lines dip below 0, meaning that there are actually job losses. Again, our strong view is today that the U.S. economy is not in a recession. It has not been over the last several years. We've added 5.5 million jobs on a base of about 150 million non-farm jobs. Today, this is a very strong indication that things are going pretty well and that there is room for a soft landing should we see things slow down prospectively. The other good news slide we have is the consumer, again, the most important aspect of our economy is in a really good perspective, pretty good shape from a debt perspective. This is a chart that looks at household debt service and principal payments as a percentage of income. When that green line is going lower, U.S. consumer is less indebted. And you can kind of see all the way to the right here over the last couple of years, we are starting from a point where the U.S. consumer is just not indebted relative to where we've been, you know, since about 1980. You can see the big difference between the kind of the Great Recession that we had in 2008, 2009, the starting point from where consumers were from an overall debt perspective. It was many, many points higher from a debt perspective, from a leverage perspective than where we are today. So again, this is kind of another good news slide that offers a reason that the economy can remain resilient. The starting point is a really, really strong one, and that the U.S. consumer is not overly indebted. And then finally, the last good news slide before I'll kind of ruin your morning is this slide here. This is a really great news slide. This is a look at cash sitting on the sidelines. It's a look at money market balances. This is both for consumers and corporations. And this is we kind of look at it as this is the dry powder that's sitting out there for either consumers to continue to purchase or for businesses to kind of reinvest in themselves and grow their businesses over time. This green line has been steadily going up and to the right for the last 2-3 years. You know, what we saw between 2010 and 2020 was kind of a steady state in this money market fund balances of around $2.5 trillion that were kind of sitting on the sidelines. In 2020, during the pandemic slowdown, our government, through many fiscal stimulus initiatives, you might remember the Paycheck Protection Program, the CARES Act, you know, direct paychecks in people's back pockets. Consumers and businesses took the stimulus payments and kind of parked them in money market assets. You can see that big spike in 2020 where we went from, you know, around $3 trillion all the way up to about $4.5 trillion. Over the last 6 or 7 months, this number has started to creep a little bit higher as well. We think there's been some disintermediation because right now money market funds are offering investors almost 5%. Almost 5%. That's really, really high, really, really high relative to basically the 0% that money market funds have been offering over the last 15 or so years. We view this again as good news in that businesses and consumers have a cushion should times get a little tough out there. They've got a cushion and can tap these assets to kind of get through a rainy day. We would kind of view this as our national rainy day fund. So when you kind of put the lowest unemployment rate in 50 years on the table, when you put we've added about 5.5 million jobs over the last 14, 15 months. When you put very low debt relative to the last 30 or 40 years for the U.S. consumer, and all of this cash kind of sitting on the sidelines is dry powder. This is your bull case. This is your argument that even if we do see a slowdown prospectively, it's not going to be that bad because the starting point is a relatively strong one, absolutely and certainly relative to history. So that's our bull case to suggest there is a possibility of just a slowdown without a recession in the next 6 to 12 months. Now, if you're near an open bar, go get yourself a mimosa or Bloody Mary, because we're going to hit you with all the bad news now. And it starts with our main issue that we're struggling with the economy, and that is inflation. My guess is that everybody that's tuning in today can offer me some kind of horror story about the restaurant bill that you got, the price of milk that you've been paying, the price of eggs that you've been paying for, gasoline is much higher than a few years ago, home prices, if you're looking to buy a home, congratulations, if you're a homeowner, nationally, your home price is up somewhere between 20 and 40% over the last two and a half years, but if you're a buyer, it's really, really expensive. All these higher prices that I just talked about kind of fuel what I'm talking about on this chart. This is a simple look at inflation. This is the Federal Reserve's preferred measure of inflation. It's that green line. And that blue horizontal line is where the Federal Reserve would like inflation to be. The Fed wants inflation to be at 2%. They're working hard to get it there. We'll talk about that in a second. But today, that green line is sitting at 4.5-ish% by the way the government measures it. The way they prefer to measure it is this measure. It's the U.S. Personal Consumption Expenditure Core Price Index. You can remember that. You're a lot better than I am. It took me about 15 years to get that alphabet soup down in my mind. But this is just a measure of the cost of a basket of goods and services, the year-over-year price increase. That's what that 4.5% means. Again, I'm not wonderful at math, but that 2% target, we're nowhere near that today. We're double and a little bit more than that 2% target. I think if you want to take a good news notion out of this slide is that green line to us, it looks like it's past its peak. It looks like we're hooking over when we're on our way down. But the problem is we still got a long way to go to get our regulators happy with where price increases are today. So this is the issue that we talk about. This is the race that we're fighting. And again, from our perspective, there's kind of two different outcomes. One is inflation breaks quickly. It gets closer to that 2% level from the 4.5% that we are today. And if that happens in the next 3, 4, 5 months, then yes, we certainly can have a soft landing without a recession. But if we wake up in December, Thanksgiving or December, and we're still sitting around 4.5% inflation, our guess is that we're going to see some tough times ahead and we are going to see a recession. And that's the race we're having. Either inflation is going to break or the economy is going to break. And we think the next 6 months are going to be a real telling tale. As I mentioned, the Federal Reserve wants inflation to get to 2% over time. The Fed kind of has two main jobs, two mandates. Their first job is to get the economy to full employment, as I mentioned. In other words, get everybody that wants a job, get them working. Again, we talked a little bit about the unemployment rate being the lowest in 50 years at 3.4%. So in our view, the Fed's done a great job of, on their first mandate, getting people working that want to work. Their second job, again, is getting inflation to average about 2% over time. And, humbly, we would offer that the Fed has failed pretty miserably in that regard. This is the highest inflation that we've seen in our country since the 1970s. It's been sticky and persistent. And once you get that inflation embedded, it's tough to get it down. As I kind of mentioned, the Fed has a blunt tool to work on inflation. And their blunt tool, or the big arrow that they have in their quiver, or the hammer that they have in their back pocket to hit an inflation nail on the head, is higher interest rates. This chart looks at short-term interest rates. This is called the federal funds target rate. This is the short-term interest rate that the Fed really controls. They can raise or lower this at their whim to manage a business cycle. So when inflation is very, very high, the Fed's tool to get inflation lower is to raise interest rates. All the way to the right, you can see that green line has been going steadily higher very, very quickly over the last 14, 15 months. We started in February of 2022, short-term interest rates basically at 0. And now they're at a target range of 5 to 5.25%. So the last 15 months, the Fed has raised interest rates, let's call it in round numbers, 5%. You can kind of see what histories look like going back to, I think that says 1980 or 1990, with your gray bars or your recessions. The notion that we've moved interest rates up 5% in about 14, 15 months, we really haven't done this in the last 30, 40 years. This is really novel, and it's because inflation is so high and so sticky. The way higher interest rates tends to bring inflation down is that higher interest rates raise the cost of capital. So it's more expensive for businesses to borrow and invest. So there's less of an incentive to do so. When businesses do less borrowing and investing, future growth slows down, prospective earnings and cash flows slow down. And when you do that across, a geography or region, a full country, you eventually see the economy of that country start to slow down. When the economy starts to slow down, the demand for goods and services slows down. So price increases of goods and services start to slow down. And that's how we get rid of inflation. So the Fed is trying to slow down the economy, to slow down the demand for goods and services, to get that inflation number closer to the 2% range in the 4% range there it is today. That's why they're doing this. Again, our view is that the Fed's job probably isn't quite done yet. They've raised interest rates quite a lot. We do believe strongly that we're past the peak of inflation, but the proof of the pudding will be over the next 6 months. Will that inflation go from 4.5% to 2% very quickly? If it does, then we will continue to see our economy grow. If it doesn't, we think we will see a recession. Again, either inflation is going to break or the economy is going to break. And our expectation is when you raise interest rates this much, this quickly over this short of a time frame, you will expect to see the economy slow down. Again, investment, let's just say it, nerds like me, we read a lot of these ivory tower reports out there, and the ivory tower reports will tell you that once you start raising interest rates, it doesn't hit the real economy on day one. It tends to take time. Usually 12 to 15 months after you start raising interest rates is when you start to see the effects of those higher interest rates hit the economy. We're kind of at the 13, 14 month date right now after we started raising interest rates. Right now is when we would start to expect to see some economic slowdown. And there are pockets of the economy that we're absolutely seeing it today. All right, so what has happened over the last 60 or so odd years when we've gone through these interest rate hiking cycles? What does history show us? And again, there's a lot of words, there's a lot of numbers on this chart. What I want you to pay attention to is the column all the way to the right. So we took a look from 1958 forward. We've had 12 different interest rate increasing cycles in our country. And we wanted to see what happened to the US economy 12 months after the Federal Reserve stopped raising interest rates. Again, what happened to the economy 12 months after we stopped raising interest rates? Our view is that after the most recent interest rate increase, it's likely that the Fed is at least on hold, or they're going to pause raising interest rates for the next couple of months to see what happens to inflation. So that chart, or excuse me, that column all the way to the right takes a look at each one of these instances after the Fed stopped raising interest rates. What happened to the economy 12 months later? And you can kind of see 7 of the 12 times that the Fed went through these interest rate increasing cycles. 1 year later, we had a recession, 7 out of 12 times. 5 out of 12 times, there was no recession. It was a slowdown in the economy. The economy kind of had a soft landing. So at the very beginning of this, I kind of mentioned that qualitatively, we think there's about a 60% chance of a recession in the next 12 months. This chart kind of informs that decision, really, because the history that our economy has shown over the last 60 or so years. 7 out of 12 is about 58%, 5 out of 12 is about 42%. So if history holds, there's a little bit higher of a chance of a recession in the next 12 months than not. It does not mean that it will happen, but this is what has happened and is informing some of our decisions to be cautious in the near term, just so that we're covering our bases. And we think that's the right advice for business owners and for investors. Stay cautious in the near term, but longer term, remaining very, very optimistic on the economy as this plays out. So I want to talk 1 or 2 minutes about some of the drivers of inflation. Most of the drivers of inflation are getting a lot better very quickly. Again, we think we're past the peak of inflation. We think it's going to get better from here. The trick is, how quickly does it get better? This slide is a look at the money supply in our country, and that's a lot of economic jargon, but really what it means is inflation tends to be a symptom of when there's too much money chasing too few goods. When there's too much money chasing too few goods, the producers of goods and services can increase their prices. And when they increase their prices en masse, that's kind of what leads to inflation. So this green line is kind of endemic of what the money supply in our country, the year-over-year growth has looked like over the last 70 or so years. You can kind of see that big spike in the green line in 2020 and 2021, and that was directly related to all the stimulus that came out of Washington. Again, we talked about the Paycheck Protection Program, the CARES Act, direct checks into people's back pockets. And our view at the time and today was we needed that stimulus to get through a kind of a nasty downturn in 2020. It really helped people, pay their utility bills, pay the rent, pay the mortgage, pay the car payment. The thing when you add that much money into an economy, and we added about $5 trillion in 2020 and 2021, it was really that there was too much money chasing too few goods. Typically, after you do that, about 12 months later, you start to see prices increases. And in 2021 through today, those price increases, we think are a function of this big increase in the money supply. That's the bad news. The good news is you can see this green line has hooked down and is now even below kind of the averages over the last 50 or so years. So if you believe that too much money chasing too few goods was a symptom of the high prices that we're seeing today, you should also believe that this number has gone down quickly and rapidly. You should believe that prices should be coming down as well. And that's what we believe. So we think, again, that we're past the peak of inflation, price increases should be slowing, and we're going to get closer to that 2% target range that the Fed wants over time. There are many other pieces of the economy where we're seeing price increases moderate. Home price increases are moderating, supply chain issues are moderating, commodity prices are moderating. These are all helping fuel this disinflationary process that we're going through. So most of the drivers of the price increases over the last several years are getting a lot better. There's one kind of skunk at the garden party that is going to be a little bit stickier when it comes to inflation, and that's the labor situation. The chart I'm showing you here is a look at price increases for employees. These are wage increases, and these are benefit increases. You can kind of see the average from 2010 to 2020 was in the 2.5% range. And where we are today, let's call it in round numbers, about 5% increases. The green line is the year-over-year increase in average hourly earnings for employees. And the blue line is something that's called the employment cost index. And that includes benefits. That's wages plus benefits. Again, you want to see these blue and green lines in the 2.5% range. And unfortunately, they're about double what they should be. And the way higher wages hit inflation is higher wages lead to lower profit margins. Lower profit margins force businesses to make tough decisions. And some of those tough decisions are businesses pass on some of those higher wages to the end consumer. And when they pass on their end product costs to us as consumers, you're going to see inflation be a little bit stickier. So again, the big picture is that most of the drivers of inflation are getting better and are coming down. There's one, and it happens to do with the labor supply that's not getting better. One or two more charts, and I promise you I'll stop boring you to tears. This is a kind of a look at our labor situation in our country. It's taking a look at job openings, less job seekers. Today, we've got about 10 million job openings in our country and only 6 million people looking for work. So we're about 4 million people short. That's what those red bars all the way to the right signify, below zero, that horizontal at zero. If the number of job openings equaled the number of job seekers, we'd be right in equilibrium. You wouldn't see a green bar, you wouldn't see a red bar. Where we are today is we're about 4 million people short. And my guess is that every business owner, every HR representative on this line today can tell me about how difficult it's been to get somebody to come work for your company. This is why we're short workers. And the primary rationale for it, the reason is it's not kind of a shorter term phenomenon, but it's a longer term one. It's in economic terms, it's not cyclical, which is short term, it's secular. And again, it's a little uncomfortable to talk about it, but we're going to do it. That chart on the left takes a look at the fertility rate in our country, the number of babies that adult females are having in the child rearing years. And all the way to the right, that green line is sitting at like 1.64 babies per adult female. Just to replace our population over long periods of time, you've got to get to that blue dotted line at 2.1 babies per adult female. So since 2007 or 2008, we have not been having enough children to replenish our population. And after 15 years of kind of getting below this replacement rate, we're starting to see it in the labor force where there just simply aren't enough people out there for the demand that employers want to hire people for. So there's lots of ways around this. None of them are easy. The first one, do me a favor, go home tonight, kiss your spouse. All right, dad joke, fine. I tend to specialize in dad jokes. I got 3 kids that always hit on me, but again, that's not an easy fix. 18 years, we'll have more people coming in the workforce, not an easy fix. The other fix is immigration. Washington and politics, they seem to not be having any issues these days. All right, find another bad dad joke. Immigration is a tough one for sure. That is a political football that I'm going to tap dance around. So there are lots of ways that businesses are trying to alleviate these labor shortfalls. They are investing in more high-tech factories, better production processes, more automation, better software, AI. They're investing in capital rather than labor to make their businesses more productive. That is probably the quickest fix shorter term around this. And our expectation is that's what you're going to see from the business community going forward. Ways to find ways to make their businesses more productive and substituting capital for labor because the people just are not there to work for all the businesses that want to hire them. So again, let me wrap it up with one more chart, and then if there's time for questions, I'm happy to take them. But again, the 20,000 foot view of the economy is when you raise interest rates as much as we have over a 15-month stretch, you expect to see a slowdown. It typically happens with a lag. We think that lag is around 12 to 15 months. And we're right at that 15-month episode where, 15 months ago, we started raising interest rates. So our view is that unless it's different this time, we'll see an economic slowdown over the next 3 to 6 months. We don't know how bad it's going to get. And that's the honest answer. The advice we're offering to business owners and investors, and that's what my main job is, to offer investment advice on behalf of our wealth management clients, is in the near term, be cautious. Again, be cautious. As an investor, maybe take some risk off the table, lower your allocation in stocks, add some cash. Again, cash is offering you almost 5% annually today. Buy some bonds and take some risk off the table. Buy very high quality companies that have strong earnings and cash flows and pay dividends. That's what we're offering to our investors. For business owners, again, it's time to play a little defense in the very near term. Raise a little cash. I know it's very hard to say for my banking partners, well, don't shoot the messenger, maybe pay off a little bit, but be cautious in the very, very near term. The chart I'm showing you here is what we talk about all the time, whether you are investing on behalf of a business or investing on behalf of a client, is that you're not investing for today, tomorrow, next week, next quarter, but you want to invest over years and half decades and decades. This chart looks at the cyclicality of the US economy going back to World War II. The gray bars are your recessions. And then the green shaded areas are the cumulative economic expansion during the good times. You can barely see them, but the blue shaded areas that are below zero are the cumulative economic contraction during your recessions or your bad times. So if a picture told you 1,000 words, it would be that the good times far, far outlast the bad times, both in magnitude and duration. So it has paid. I could take this chart back another 150 years. It has paid to bet on the resiliency in the American economy. It has paid to bet on American capitalism, entrepreneurship, technological advances, and the pro-business cycle. Let me wrap it up with this, old adage in investing. Kind of the 4 most dangerous words in investing are, it's different this time. It is almost never different this time. And our view is, whether we have a slowdown or a recession in the next 6 months is largely irrelevant over a 5, 7, and 10-year period. And that's the way you as business owners should be investing in yourselves. And that's the way we as investors are advising our clients to invest. Again, there are some free lunches in investing, and it's diversification in time. And if you are in the market for years and half decades and decades, we have a pretty good idea of kind of the investment returns that you can expect to achieve. And I think there's a very similar correlation to business owners. If you are planning, being cautious in the near term, but planning for a pro-cyclical return like we expect to see at some point in the next 6 to 12 months, we expect you're going to have many, many years of growth ahead. So thank you for indulging me today. Thank you again, Mark, for the invite. I really appreciate it. If there's time for questions, I'm happy to take them, or if you want to shoot me off stage, I'm happy to get off.
Yes, Tom, we do have one question. Can you address the impact of the debt ceiling not being raised?
Yes, absolutely. This question has come up in every single meeting that we've been having over the last several months. Our view is an optimistic one, and I think we share that view with most investors that are out there. Our view is that it's not a question of the government's ability to pay its debt, but its willingness to pay its debt, and that's a really important distinction. We think that this is political posturing. We've seen the debt ceiling raised, I believe it's 21 times since 2000. There have been a few contentious ones that have gone down to the 11th and a half hour. And ultimately, cooler heads prevail. Because the opposite would be very, very detrimental to the US economy. And maybe more importantly for the debate, it'd be very, very detrimental for the prospects of many of these politicians getting reelected. So there are very strong negative consequences should we not raise the debt ceiling and default on our debt. We think that likelihood is very, very low. In fact, it has not happened in the last 20 years. It has not happened in the last 80 years. We don't think it's going to happen this time, but you will be seeing and continue to see sensationalist media reports on the two parties being very far apart until the very last minute. And we do expect a last minute deal to be done for a variety of reasons, not the least of which is the politicians that are at the heart of this debate are not electable should we go down a fairy tale path. It's a very good question. The drop dead date on this, we believe, is June 1st. So there's going to be a lot of volatility between now and June 1st.
You have a question, Tamika?
Thank you, Tom.
Thank you very much for the invite, for your time, and I'm going to pass it back to Mark. Thank you.
Thank you, Tom. Very interesting information about the economy. And certainly take note as you are running your business, whether small, medium, or large business, for those of you tuning in later. We realized a couple of the slides were missing up front, but we got that technical issue straightened out. And I think we're checking to see whether or not the slides will be shared. Okay, yes, the slide, thank you very much. The slides will be shared. And I just stopped sharing, thank you. So the slides, in fact, will be shared so that you can certainly review the information that Tom just talked about. Tom, again, thank you very much. And a lot of questions, those are the most common questions every year. That's why we have the theme, navigating your business with an uncertain economy. And this is certainly some challenging times, although I think Tom put it very well. And I hope you get a chance to took some serious notes and paid attention to what he said. All right, by the way, before we proceed, I neglected to say, please feel free to use social media. The hashtag is Small Business Workshop. Hashtag is Small Business Workshop. And also my Twitter handle is Lee Group, @Lee Group. And I promise I will retweet and we will share with as many people certainly to see this as possible. All right, we're gonna have a panel discussion right now, and we're gonna focus the panelist conversation on preparing small businesses with economic headwinds. And I'm very pleased to welcome our panelists up here to the stage. And first we have Ms. Juliana Perry, and she's the business banking relationship manager for Fifth Third Bank, Eastern Region. We have Ms. Anya Stone, who's the capital access manager for Build Institute. And we believe we have chiming in Mr. Ray Waters, who is the president of the Equate Development Fund. And he should be chiming in. Each panelist has a microphone. As you respond to the question, ask you the owl, as opposed to the respond to the owl. So that way you can see. Excuse me. Do we have Ray Waters? Yeah, there's Ray.
Hi, Mark. I'm sorry I can't be there today. I had a conflict, and but I'm here generally via the television.
Well, Ray, we appreciate you. You do this each and every single year. You're doing a great job. Always appreciate Ray's input. So what we're going to do, if you have questions, continue to drop them in the chat so we can monitor those as well. And as we get started, again, the theme that we're focused on is certainly navigating or preparing your business with economic headwinds that Tom laid out very clearly earlier. So I'm going to give each panelist 2 to 3 minutes to introduce themselves, their organization, and what they perceive to be the most significant economic business headwind for 23 and beyond. So we'll start with Juliana Perry from Fifth Third Bank.
Good morning, everyone. Thank you again, Mark, for the invitation. This has been an ongoing relationship that we've had with you and the small business community out there, and we're happy here at Fifth Third Bank to remain a part of it. Fifth Third is a super regional bank in the Midwest that has over 200 billion in assets. We support small businesses as well as large businesses. And as you heard Mr. Jellick speak to our investments, we also provide investment strategy. As an institution, we believe that we survived based on our affiliate model, as well as our ability to remain on focus, really looking at our customer relationships as the primary driver for our actions and things we do in the community. I believe that, as we've talked about a little bit today, there is a lot for small businesses to be aware of and to be cautious about. I think that they should be cautiously optimistic about their future, but certainly strategize whereby they have made clear decisions, quantifying them to manage their growth. I always say all growth is not good growth. However, in this economy, I think they will still be challenged to grow by the labor shortages. So as we continue to have this dialogue, thank you again, Mark, for allowing us to be here.
Absolutely, my pleasure. Again, we appreciate your support. You've always been a great business partner. We're going to segue over to Ani Stone, as she's with Bill Institute Capital Access Manager. Give you 2 to 3 minutes to talk about your organization and address the question whether, from your perspective, what the most significant challenges, economic headwinds facing organizations.
Hi, I'm Ani Stone. I'm glad to be here today. I'm here with Build Institute. We're located in Detroit, in Corktown. We are a small business incubator. We especially help micro businesses, businesses with 10 employees or less, making 100, 250,000 or less. And we support them with education and helping them connect with other entrepreneurs and launch and find funding. So we kind of provide wraparound supports. And working with people that are in the, launching early ideator stage, all the way up to justified stage, we see a range of different challenges that people will face with the economic headwinds that we're dealing with right now. So it's going to go down to each person thinking through their situation and how they want to adjust. If there is a chance that things are going to close down or slow down, some people are going to want to manage risks. Other people are want to come up with creative solutions and diversify. So everyone should look for the supports out there and find ways to address the situation, according to their business.
Okay, thank you. Last but not least, Ray Waters from Detroit Development Fund. We'll give you 2 to 3 minutes to just briefly give an overview of the organization. And for 2023, from your perspective, the most challenging economic headwind for small businesses.
Thank you, Mark. Again, happy to be here today. We've been with Mark on this small business event for several years now. The Detroit Development Fund is a nonprofit economic development fund. We're a certified development financial institution. And our goal over the last 20 years has been to help small businesses in Detroit by providing loans to companies that aren't yet able to get bank financing, provide them technical assistance to help them grow, and eventually move them up the ladder. We do companies that aren't yet able to get bank financing. And that's not that Fifth Third doesn't want to do it, but they're a bank and they're highly regulated. And they can't do the loans that we can do because we are not a deposit organization. But because of their heart being in helping small businesses, Fifth Third has been very generous in supporting organizations like ours that allow us to go out and do some of the things that they can't do. We started this about 20 years ago. We have now lent $80 million into the small business market in Detroit. 85% of those loans have been made to companies in Detroit owned by entrepreneurs of color. 7 years ago, we started specifically the Entrepreneur of Color Fund. And last week, 2 weeks ago, had an event that recognized the help that many organizations gave us to do that. The Kellogg Foundation, Fifth Third, JP Morgan Chase, and as of last week, we now have $18 million loaned into the Entrepreneur of Color market here in Detroit. Small businesses that need the financing to grow. So we've been very fortunate to have good partnerships and to find good companies out here in Detroit that can use the technical assistance and the help. What we see, Mark, I think the most frustrating thing for our small businesses today is the employee issue. Many of them really need to hire people to start growing their business. We have a lot of retail, but they can't find people that want to come in and work. And that's the issue that we see that's going to move forward. Obviously, to do that, you have to, what the gentleman said earlier, raise salaries, raise rates. And as a small business, that's just a little difficult sometimes. But that's the biggest issue. But one thing we've learned over the years that when you're a small business owner and you're an entrepreneur, you have a lot of drive and passion, and you figure it out one way or the other. And that's what we hope our entrepreneurs will do.
All right, Ray, thank you very much. Let's just jump right into the conversation. I want to pick up where Tom left off as part of this presentation, the state of the economy. How do you feel, how should Juliana, entrepreneurs feel at this point? Should they feel optimistic? Should they be cautiously optimistic, neutral, pessimistic? You know, based on that backdrop that Tom just shared with us.
Well, I really think that business owners that are engaged in what's happening with the economy understand that we have to go through these cycles. And at the end of the road, there's the light. So follow the yellow brick road, to coin some Wizard of Oz, verbiage. But when they see that their revenues are built on the labor costs and the cost of delivering that product, so you have those variables in there. They really got to look closely at what they're doing, what projects they're working on, and it depends on the industry too. So I think that they should be cautiously optimistic that if they are doing the right things, managing the business properly, and I had an example of one client who was very aggressive in quoting jobs from 10,000 to 2 million. And ultimately what they ran into was labor cost issues and cost of capital changed on them. So those are things that I think people or business owners have to be aware of, but truly determine if going after that customer is the right thing to do right now.
Yeah, and
And
Fifth Third has a very strong relationship with small businesses in Detroit, of course, and across the entire footprint. What are they telling you when you run into entrepreneurs and small businesses? How do they feel? You gave us how you feel. What are they saying, and how are they feeling?
Yeah, I think some of them are really feeling that, hey, I'm doing this. Why isn't this working for me? I hear frustration, with the labor market. Clients that can grow from 10 to 15 million but can't. because they can't find the labor, clients that may want to retire
Mhm.
and can't. So we're running into some of that as our baby boomer generation ages, and that generation of business owner is looking around to say, what's next for my business? They have to understand that their son or daughter may not want to be in their business, there may not be a key person, so they have to consider the next step for their business, and they do want it to survive because that's their baby.
Yeah.
So I think they're scared.
This year, of course, and I want to come over to you. I had the opportunity recently speaking at, hosting, emceeing an event where Build Institute was having a super bowl. And there was a lot of enthusiasm in that room. The place was absolutely packed. It was an honor for me to do that. So let me ask you the same question, because you're more so incubators and that people are, interested in starting a business. What is your mindset right now? How are they feeling? There was a lot of enthusiasm in that room, but from your perspective, how are they feeling?
Yeah, I think a lot of entrepreneurs who are looking to start, they're thinking a lot about coming out of the pandemic. So they were kind of sitting on ideas and waiting for the chance to get going. And now things feel more open. So they probably need to be thinking about the bigger picture and keeping the broader economy in mind. Because a lot of them are just excited to finally be open again and able to do the ideas they've been working on and put them into action.
Yeah, and Ray, we heard that Juliana said that she used the word frustration, frustrated. From your perspective, from Detroit Development Fund's perspective, what's your take? What are your thoughts on how should small businesses and entrepreneurs feel at this point for the people you deal with on a daily basis? How are they feeling?
Yeah, it seems to me that most of the entrepreneurs that I'm working with are facing the same problems that everyone's been talking about in this room. Issues with feeling the crunch of inflation and having trouble finding employees and retaining employees. All of that stuff it's hitting everybody, even on the small scale. And so that's an important thing for them to be thinking about, creative solutions to that and not getting, blocked when there's, an obstacle, but coming up with creative solutions, which is what entrepreneurs are best at. And so, my thought is that entrepreneurs should, think about their strengths and think about creative solutions like they always do. And if there are some tough times or bumps in the road, coming from a point of strength and knowing what they're good at and finding ways to address it.
Yeah, and Ray, I want to give you a chance to respond to the same question again, from your standpoint. How are the businesses that you're dealing with on a daily basis? How are they feeling? How should they feel?
I would say that we see a lot, particularly coming through COVID, and so many of them that we helped get through with a variety of ways. But I would say frustration at the moment is what I sense in and we have 200 and some small business companies in our loan portfolio right now. And I think it's frustration. What do you do? And the good folks at Build know how important this technical assistance is, as we do. And that's what we're trying to help these companies with now, is move them into some more technical assistance to help them understand the market, help them understand a few things, how to do things a little differently. But it's an adjustment. And so many companies are, they're working 24 hours a day trying to get their little company moving. They don't have time to spend on some other things. So that's where we have to help them. But I would say frustration, number one. And the one thing that we're seeing and we're recommending more and more is changing how you market your company. It's just the world has changed out there, and we have a lot of restaurants in our portfolio. And you know what happened to restaurants during the pandemic? It was just scary. And so now they're moved to takeout and other ways and pickup. And those are the kind of changes that small businesses have to make. But without the help of like Fifth Third and Build and the work we do with TA, they need help figuring that out. And that's the key, I think.
Yeah, and as we're going through this panel discussion, and that's what Bruce Smith as part of the Fireside Chat, I want you to take note. We want you to walk away with practical solutions. We want you to write down what you can walk away and start to implement today, as opposed to just listen to us talk and answer questions. I heard Ray, for example, just talk about marketing your program, marketing your business. You may need to change how to do that. Juliana, I want to come back over to you because you want to add an additional comment.
Yes, I think, again, today, business owners have to look at the cost of starting a new product, starting a new line, starting a new location, etc. And quite frankly, I've had two folks change their mind because the cost of capital was too high.
You know, and you talk about the cost of capital. I recently had someone approach me and I talked about it with some other people. Had a very successful business pre-pandemic on just east of downtown. It was a fitness type of facility. Didn't make it. They came back from the pandemic, and as recently as within the last 3 to 4 months, person shut down their business. And the question I asked on Stone, and I give you a chance to address this, is well, what happened? I said, what happened? And the individual said, well, the people were here before the pandemic, but they didn't come back after the pandemic. And then this person decided to leverage technology. It was a physical fitness facility, but at that point in the game, it was too late. Talk to us about that. What do you tell those folks who are coming in, listening today, viewing in, or later via the recording, address that issue? People were frustrated, now they're starting to walk away.
Yeah, I've seen that as well. There's an entrepreneur I've worked with recently who had a food industry business for quite a few years and did not make it through the pandemic. But like many other entrepreneurs, she's going on to start a new project. And that's what many entrepreneurs do. They're very resilient, and if the first idea fails or the first iteration fails, the next one's going to be better. And so when there is an issue like this, this entrepreneur is facing with, finding people willing to come to the gym again after COVID, they are going to have to probably, slow down, step back, and reassess before they can move forward.
Yeah, again, if you have any questions, drop the questions in the chat. Tamika is going to be monitoring. We'll give you a chance to ask questions as well. She will be asking questions later today out. Ray, I'm going to come back to something that you just referenced a few minutes ago. We saw in Tom's presentation approximately 10 million jobs, and I believe he said 6 million people are actively looking. And I've heard the same story again from a lot of businesses, small, medium, and large. You introduced a concept called ghosting, where people, it's hard to find people, but two, even the people who are coming in, they decide not to show up. This concept of ghosting. Talk to us about that. How do businesses adjust? I'll give the other panelists a chance to respond, but how do they adjust to the thing called ghosting? And how do you continue to find people in this tough marketplace?
Well, that's a good question, and I really don't know the exact answer to that. All I know is they're out there trying to bring people into their work, and people, they hire people and then they don't show up. And I don't understand that from a employment standpoint and why that happens in this economy. But what we try to do ourselves with them is we have a couple of staffing companies on our that work with us. And so what we've been trying to do is help these staffing companies go to them, and so they can present them with a group of employees that they need, and they don't have to go out and literally search for them themselves. And that's, by the time you put ads in the newspaper and do all of that, that's the tough part. But we're trying to solve some of that issue by helping some of our collaborative staffing partners put together a list of people that they've interviewed, and would be willing to work. And we're trying to solve some of that by doing it that way. That's not the answer completely, but we've certainly seen a lot more of our small businesses in the last 3 months take advantage of working with the staffing companies that we have on our team.
And I want to come back over to you. So people, as they're thinking about starting their business again, coming to build an institute for ideas and support. Has that question been raised to you? Yeah, I'm a solopreneur right now, but you may have a couple of people who have to hire people. And what do you tell them in this tough labor market in terms of hiring people, the idea of ghosting? What do you tell that person?
Yeah, we have some really cool entrepreneurs and residents, and they're people who have been in business for years, and they give one-on-one support to entrepreneurs who are facing specific challenges like this. And often they'll give them a multifaceted approach. You know, you can work on building systems and have your digital interface, supporting you, and that can really cut down on certain needs. And you can also come up with creative staffing solutions. There's websites and apps out there where people can do odd jobs here and there and fill in gaps. And then businesses have always been really creative about finding ways to attract employees and finding different benefits and different things that people want to see. And that's a really important way to be an attractive employer. So, attacking it from multiple angles is a really good approach.
And Juliana, coming back over to you, we talked about adjusting, from a Fifth Third perspective, obviously a regional bank. And what do you tell those folks who are trying to find people? Is it simply just paying more money? Is it simply just paying, X number of dollars per hour to Y number of dollars per hour? Is that the answer?
Yeah, it's a tough point. From franchises that we have like McDonald's or Subways, to the larger corporate contractors, et cetera, skilled labor is an issue. We do as well help our clients if they come to me and say, hey, Juliana, I'm looking for XYZ. I do have portfolio clients as well that are employment agencies. I'll connect. A couple of my clients have come back twice for the same role, but they come back. So I think it's important for us to listen to that, to provide, opportunities for them to network with other employment agencies, other organizations. Maybe they do joint ventures, as some of the other speakers have said. It's an evaluation of potentially, is this a role that my company really needs now? How can it be done differently? So I think it's a constant evaluation and flexibility by the entrepreneur to lead their organization, and every aspect has to have a constant fluidity.
And I want to stay with you for a moment, Juliana. We've heard Tom talk about the cost of capital, inflation. I want to stay with Fifth Third for a moment. How should businesses adjust to the increased cost of capital? Payments on credit cards, for example, and other costs in financial business. What suggestions or recommendations would you have in order for them to adjust moving forward?
So managing the cost of capital is one of those variable costs that they can't fix it and say, I'm gonna pay $1 for my loan. It's not gonna allow us to be profitable as an organization, and it's just not realistic. So they really, really have to look at, is this the right time to buy a new piece of equipment, buy a used piece of equipment, maybe even lease. But then you're looking at accounting changes that are impacting small businesses to large businesses because of the rules to put leases back on the balance sheet. So it's a constant, battle or opportunity. Let's not say battle. Let's look at it as a constant opportunity for that business owner to evaluate, is it truly this way to go right now, or do they hold on? Because again, that can't be controlled. So are they going to replenish that person and use that as extra money to borrow for working capital? Or are they going to look at other projects that are maybe quicker to produce, don't have as much material needs, etc.?
Okay. And Ray, I want to come back over to you. I want to stay on this thing called financing cost of capital. And I know that you have a loan fund. And so, we think of Fifth Third Bank, we think of traditional financing. I want to give you an opportunity to address financing in this changing world from your perspective, how can businesses adjust with the type of funding that you have in this environment where the cost of capital is higher?
Was that directed to me, Mark? I'm sorry.
Yes, so I know directed to you, Ray, yes.
Thank you. It is a challenge. There's simply no question about it. What we see so often as companies that come in our door that we provide funding for is small companies who, when you get in a bind, I've been there a few times with companies I've owned years ago, you get desperate. And so we see so many companies that go online that, oh my gosh, I can get a loan approved in 24 hours. Well, they go on to Cabbage or someplace like that. They get a loan approved in 24 hours, but then they realize it's 20, 25%, or sometimes higher interest. And you do things like that when you're desperate. So we have fortunately taken a lot of small companies out of those with our loans. We charge between 7 and 8%, which is typically higher than a bank. But for the risk we take, we don't want to get into the 10s or 11s. We think that's too high. But that's what we're seeing the most of is the 24-hour I could go online and get a loan approved. And it's really a problem for small businesses, more than people really, I think, understand. But that, and then the other thing that we try to do, and Fifth Third does this a little bit too, is sometimes they don't need a long-term term loan. They just need a small line of credit in order to get themselves through a job like a contractor. And so we provide a job-specific line of credit, interest only until it's paid off. So it doesn't really affect their cash flow except for the interest. So you just have to be creative and flexible and search out anybody that has mostly anybody that won't say, I'll approve your hour within 20 or your loan within 24 hours.
Okay, and I want to come back to Anya Stone. Let's go back 12 months ago. Right, okay, things were easy up with the pandemic, but it was still there. We know that we're kind of, from a federal standpoint, technically supposed to be behind us. They're treating it as an endemic, so to speak. So my question is, you know, what were the specific challenges a year ago versus today? Or are the exact same challenges over the last 4 months?
Yeah, for a lot of the small businesses we work with, some of the things have gotten easier just because the issues with the pandemic were more prevalent then than they are now. So they're having a better time getting people to come out, and they're having a better time doing things in person and reopening the way they did before. And they're also having an easier time with some of the logistics and supply chain issues they were having before, which is really amazing. And we're also finding more people that are taking action on their ideas and coming to us for technical support. So that's really cool too, seeing people that are really ready to dive in and work on their idea with us.
So, and speaking, I'm just kind of curious to those, if I went for those tuning in, Build Institute is located on the famed corner of Michigan and Trumbull. That sounds familiar, the old Tiger Stadium site. So as people are coming, excuse me, as people coming through the front door, what types of businesses do they want to open right now? And how has that changed compared to, let's say, 5 years ago?
Yeah, there's a wide array, but everybody is more digitally aware than they were before. So that's obviously the biggest difference. And we're making sure that we provide more of those supports because people need to understand that we're in a completely different world where you cannot just have a physical location. For most businesses, you need to consider what part of your business needs to be online and digital. And so we still have a lot of, you know, little mom and pop shops. We have people that are retailers of all types. We have manufacturers. We have, you know, beauty supply. We have salons. We have technology businesses, people building apps. So a wider range of array of things coming through, but all of them are more aware of the world we live in now.
Yeah, and I'm just curious, is that with AI? Are you seeing that, is that driving a lot of people's ideas, do you think, as well?
Yeah, I mean, we've seen a number of classes lately where they're teaching people how to use ChatGPT to build their language on their websites, and this is for people starting out, you know, this isn't crazy and far out anymore.
I'm still trying to figure out, turn the PC on.
We're baby boomers, Mark.
Let me come over to you. Let's go back 12 months, same question. What were the challenges for small businesses 12 months ago towards the end of the pandemic? And let's fast forward to today. Are they the same? Are they different? How have they evolved or how have they changed?
Well, surprisingly or not, a lot of the challenges are the same.
Hmm.
I actually have clients telling me that the supply chain issues remain. That if they don't order today for a component that they need in September, that the whole job is delayed.
Hmm.
So, I don't see, from what I'm hearing from my clients, that there's a lot of change from last year. Now, complicate that by having almost a doubling in the interest rate or more.
Yeah.
So, there's still a lot of challenges. So again, as I mentioned, companies aren't doing as much borrowing if they can. They had some of the liquidity from the prior 2 years still in the balance sheet. They may be burning through some of that to buy equipment or materials, etc. But you still have the labor costs challenges or lack thereof. So I think there's a lot of similarities to last year that just are exacerbated by the fact that we have a higher cost of capital. So obviously that makes things a little more concerning for an entrepreneur to move forward with.
Yeah, and just as an aside, you know, I lease vehicles, I've been leasing vehicles for years. And I happened to send an email to my dealership a couple months, maybe about a month ago. Because my lease, I got a 2-year lease. And historically, I could go into the lot and drive the car off the lot. I said, hey, how much lead time should I give you if my lease is expiring? And then I sent him an email back in March. And he says, you need at least 6 to 9 months. 6 to 9 months. So in other words, my lease expires in March of next year. He says, you may want to consider putting an order in for your vehicle, or at least give us an idea today.
Sure.
Is that what you're still seeing in terms of, yeah?
Yeah, still seeing that, still hearing that about car issues,
Yeah.
about other components. And I know we've talked a lot about onshoring, you know, having our resources locally or domestic as opposed to overseas or international. That's putting stress on the system too. Because again, a lot of, you know, the companies weren't prepared for it.
Yeah.
So they still have to shore up, you know, their shop to make that happen.
So what I'm hearing here, for those of you tuning in, is to make sure that you have the appropriate plan. Adjust your plan accordingly. Look at your supply chain management, look at your costs. Go back and review those to make sure that you're properly set up for these challenging economic headwinds. Tamika, I want to turn over to you for a moment to see if we have any questions.
Yes, we do have one. Assuming pay and benefits are competitive, are businesses evaluating other key factors such as culture, flexibility, training, leadership that affect talent, traction, retention, and performance?
Who would like to take that one? The panel's thinking.
So if I heard the question correctly, are entrepreneurs considering alternatives to plugging their labor gaps? Is that a good summary of it?
Yes.
So I think it's as Anai said, you know, they're looking at, are there other tools of technology? So for example, a small communication company that had to have administrative staff in office, they don't have to have that anymore. They can use a service and that's outsourced. So essentially that customer service center is centralized and they may be first of all, it's an opportunity for another entrepreneur who has a call center that supports other businesses like that. And that was a way where he found something that was an alternative to having more bodies in the shop.
Okay, Ray or Anya, I can give you a chance to respond. Anybody else, any other input?
No, just, I think the short answer is companies are changing. And what we're seeing and providing more technical assistance for so many of our small companies, we're not personally, but experts that we collaborate with, is the technology piece, exactly what you said earlier. At my age, technology is a little over my head, but for these small companies, you can do so many things now with your website, your social media, your accounting, all with good technology that if you get properly trained on it, can really help your company move forward without having to hire, an additional person to do it. And I think that's the basis of what we're seeing for small companies trying to move themselves forward now is better technology and quicker ways of doing things.
As we wrap up this part of the conversation, I'm gonna ask you all to give specifically one question to address the practical solutions. So specifically, what should entrepreneurs focus on moving forward to address these challenges that we have been discussing? So what specifically should they focus on to address these challenges and be very specific and provide at least one practical solution? Ray, I'll start with you.
I think that I'll do two quick ones. The one we just talked about, the technology. It's critical that you get up to speed and understand how you can use it better. But I think the single biggest piece that we see is kind of technology, but changing how you deal with your customers, how you reach out to your customers with a better social media, website, all of that. Some help and training in that is critical, I think, for small businesses, because as I said, the restaurants used to have people coming in droves to get food, and COVID changed that. So how do you reach out to them and how do you keep it going? And I think it's that piece that really is a critical piece to helping small businesses now.
Okay, thank you, Ray. And Ani?
Yeah, I would say for the small businesses in Michigan and Detroit area, take part in your community. We have roundtables where you can sit and talk with other entrepreneurs in your industry and come up with solutions, and that's a good way to work through things. Also, feel free to talk with other experts, do some research, come up with creative solutions, and look for support and community when figuring out some of these issues. And all of the other things that you're going to need to do to adapt can be done easier with other people.
Okay, we'll go to Juliana Perry for the final word.
Well, I agree with my fellow panelists here regarding the suggestions made. In addition, we just want to add that there should be good advisors for every business owner, not just your team on site. Reach outside of that team. As Ani said, look at your resources within your industry, both horizontal and vertically, to determine who's a good partner and have that advisory board. I see a lot of small businesses that miss the boat because they don't have good financial record keeping. I think that in today's environment, we've got to be on top of that information. What do we really know about our business? Do we just look at what's in the bank, or do we look at our financial statements that are produced? And I think it's important, especially as we look at the cost volatility in both our labor market as well as in the cost of materials, that is handled by professionals. And if the entrepreneur doesn't have that skill set, that they engage with someone. We've heard about a lot of technical resources between Build Institute and Detroit Development Fund. And so there are a lot of technical expertise. There's a lot of technical expertise out there, and small businesses should avail themselves of that.
Okay, and I want to thank Juliana Perry, business banking, relationship manager for Fifth Third Bank, Eastern Michigan region. Ray Waters, the president of Detroit Development Fund, Connie Stone, Capital Access Manager, Bill Institute. I would somehow like to get your contact information, so can, maybe Tamika, can they put their information in the chat room, or how should we do that to get their contact information out there?
Yes.
Okay.
What information would you like to provide? Your email addresses?
Sure, that's fine. I think on the bottom of some of my emails, you might have my corporate information.
Sure.
Okay,
And real quick, the website for Fifth Third is,
53.com.
okay, so 53.com, and for
Build is buildinstitute.org.
BillInstitute.org, and for Detroit Development Fund, Ray.
DetroitDevelopmentFund.com.
That's all we need there, to make it just drop, we'll just drop the websites. Again, I want to
Okay.
thank Juliana Perry, Ray Waters, and Monty Stone. We appreciate it very much. Thank you very much.
Thank you all. Thanks, Mark.
Thank you, Ray. We appreciate it.
Thank
What
you.
we're gonna do is the segue now is I'm gonna introduce, we're gonna have a fireside chat. A fireside chat with Bruce Smith. And before I do that, I want to welcome up Chanel Stitt. And Chanel is the business reporter with the Detroit Free Press. And she does a great job. She covers entrepreneurship and small businesses primarily for the Free Press. You probably have read her stories in the Free Press. And she does a wonderful job. I also like to welcome Mr. Bruce Smith. He's the chairman and CEO of Detroit Manufacturing Systems for a fireside chat about how DMS continues to grow during these challenging times. And I'd like to take this opportunity to give you a little bit of background information about Bruce. He's a manufacturing industry expert with over 30 years of proven experience in building superior teams, increasing profitability and accelerating growth, consistently and substantially improving enterprise value at every organization he leads. He's currently the chairman and chief executive officer of Detroit Manufacturing Systems, a large-scale component manufacturer for global brands with over 1,500 team members, primarily here in Detroit, with over $1 billion in annual revenue. And before joining DMS, he worked closely with leading private equity firms and entrepreneurs, holding key executive management positions, including president and CEO of BTM Company, a global leader of precision engineered tooling and production equipment for sheet metal clinching, piercing, and inserted passenger applications. With Smith at the helm, the organization grew 40% in a 3-year period. And he previously served as the president and CEO of Illyria and Hodge Foundries, a provider of high engineered castings, and president and CEO of Automotive Supplier Piston Group, a modular assembler of automotive components, president, COO of Yokohama Mills, a supplier of automotive interior fabrics, and president and CEO of United Plastics Group. Without further ado, I'm going to turn over to Chanel Stitt, and they're going to have a fireside chat, just the two of them, for the next 25 minutes or so. So we'll turn over to you, Chanel Stitt.
Thank you so much. I'm really excited to be here with you. You have such a long, extended resume. You've seen a lot of things. You've had a great experience. But let's talk about DMS. So talk about the goals of your company and what you do each day.
All right, next. Hello.
Should we turn over?
Let me try that. All right, there we go. Excellent. With all those years of experience that Mark referenced, I like to state I started when I was 5 years old. And so, to your question, Chanel, our goal at DMS is simple. We want to change the world. And we want to do it one person at a time. And we do it by creating a unique culture where we truly put a lot of energy, effort, and focus into creating an environment where people get to be the best, boldest, most authentic versions of themselves. And in that, we believe we'll get the best work. And as a result, we'll be able to do things that are beneficial for ourselves and our customers, and then also our community at large and the folks who work with us.
So we're gonna go on a timeline here and backtrack a little bit. Talk about the economic state of your company during the pandemic. Like, what was that experience like for you?
Yeah, the pandemic was, it was interestingly enough, two things. It was extremely challenging, as I'm sure many of the folks who are listening to me now can attest to. But there's a person on my staff by the name of Ben Beecham, who's our chief operating officer, who always says, never let a good crisis go to waste. So within the pandemic, we also deliberately looked for opportunities and found many of them. But as some of the panelists have talked about earlier today, there was this convergence of, in my industry, lower volumes. We didn't have the benefit of being Peloton or Amazon or hand sanitizer salesperson. Volumes actually were enriched during that time. Our volumes went down. We also had the labor shortages that everyone has talked about, the inflationary impact across a number of categories. And then lastly, supply chain interruptions. And so within that, it was very challenging. But we took an infinite mindset, and a couple of things that we really adhered to were, one, how do we make sure that all of these traumatic impacts in the outside world don't just flow directly into our company, and how can we as leaders create a buffer zone to where we still created a sense of normalcy within our company, even though the environment was, crazy and off the rails. And so simple things like we didn't force any mass layoffs for our salaried folks. For our hourly people, we did the math and said there's enough money from government assistance that they're going to be fine financially. But for our salaried people, we didn't touch their base salary. We didn't force any layoffs. We got more creative by asking for furloughs and deferred things like the 401k match. We felt like we had a really good balance between doing what was right for the business, but also doing what was right for the people in the business. They knew that we truly cared about them and their families. And that combination, I think, really helped us get through it. In addition to doing some things financially and commercially and operationally that allowed us to survive it and come out on the back end stronger than we went into the pandemic.
And let's touch on one of the topics that you mentioned, supply chain. How was it navigating through that, and is it still an issue today?
It was challenging navigating through that. The amount of phone calls that my teammates were on just to track what was output going to be like from a number of suppliers. When would the parts arrive? How do we coordinate our production and labor plans around that? And I got to admit, my team did a fabulous job. At no time during that pandemic did we ever shut down one of our customers. So great job by the team that I work with. Pre-pandemic, we might have one supplier that was what we call a critical supplier that was maybe going to negatively impact us. Most of that number was zero. Even as we speak today, we've got 20 suppliers out of a field of over 150 that we would call critical, where we're keeping a watchful eye on them and working collaboratively to make sure that they don't negatively impact us. But supply is constrained still in a number of areas. It's gotten better since 2020, but it's still not where it was prior to the pandemic.
And I'm adding another question on you, sorry. So let's talk about the labor shortage as well. Like, how have you navigated through that? Because we talked about it a couple of times today.
Yeah, we've done a number of things, and because everybody's business is different, I don't know that all of the tactical things that we did are applicable to other businesses. But I'll give one example. We went by zip code and looked at unemployment rates and sent out old-fashioned snail mail flyers to people's homes to say we're hiring and looking for good people. We've also added flexible scheduling. So if you only want to work 2 shifts a week, we have an opportunity for you to do that. So you can fit work around your life instead of trying to force fit your life around work. So getting creative and being flexible has been at the heart of a lot of the things that we've done. But I think the thing that we have done and continue to do is what I mentioned to you earlier, which is we're really creating an environment where people understand that we care about them and we want to do the best for them and with them. If you look at our website and our values and our vision, we really talk about 4 things: being servant leaders, which is subordinating what's good for me in the immediate moment and doing what's best for those around me, knowing that eventually reciprocity works for all of us. Secondly, is we want to enrich lives. So even things like if you wanted to be a barber, you can come work for us. We'll help pay to get you through barber school. And when you're done, go be a barber, send one of your cousins to come work with us. And so really saying, how can we enrich the lives of others? Thirdly, how do we rise together, which really is about how do we make sure all of us do well? And then the fourth one rather is giving back. And that's being cognizant of the communities that we're in and making a concerted effort to help people who are outside the walls of our, four walls of our building, so that we're creating an eco cycle here that benefits everybody.
And so, talk about the current economic state of the company and, what do you need as a business owner in the city as well?
Yeah, current economic state is, thank goodness we're profitable, ongoing concern. Because volumes haven't quite come back to where they were prior to the pandemic. It's not as good as it was then, but we're doing well. And so we're pleased and blessed to say that. In terms of what we need from the city, I've got to tell you that anytime we've reached out to the mayor's office, they have been very responsive. So whether it's helping us create better access in and out of our building to help alleviate some of the traffic concerns, or if there's anything that we need in terms of networking within the city to get to the right folks to satisfy an immediate need, they've been helpful in that regard as well. So there's nothing I can think of above and beyond what we've already got from the city that we need incrementally.
And what advice do you have to other business owners that are navigating through this uncertain time? Because that's the theme today, we're navigating through uncertain times. So what would you say to them?
Yeah, I would say, one, plan on things being uncertain for the foreseeable future. If you're waiting for stability and predictability, you're probably waiting for a bus that isn't coming. And we've talked about the economic uncertainty, but look at what's happening from a technological perspective. I'm in the automotive industry primarily. And when I look to the future, the changes over the next 10 to 15 years will be more radical than the changes in the prior 100 years with EVs, electrical vehicles coming online, and autonomous vehicles. And so I would say, prepare yourself to expect the unexpected. And in that regard, I think there are a couple of things that are conceptual, but are important to being excellent tactically. So one, have a spirit of gratitude. I always tell my kids, every morning you wake up, either pick gratitude or an attitude. And choosing gratitude, I think puts you in the right frame of mind and the right spirit that you'll start to build and track positive relationships. And you can think more clearly about what you need to do to be successful. And so I would say that. The second thing is I would say embrace the uncertainty, embrace the challenges that it brings. I don't know a single person who ever got to something that didn't go through something. And so using these challenging times as a way to build muscle and resilience and to further cement good relationships is important. I would say, thirdly, surround yourself with the right people. A friend of mine, Dan Russell, who works over at Tri, shared a story with me, or a little phrase in January, where he said, if you look around your circle and you're not inspired, you're not in a circle, you're in a cage. And so surrounding yourself with people who are willing to challenge you, who are forward thinking, who are infinite thinkers, and who don't scare easily, and are smart. That helps as well, have great values. I think that's important. And then the last thing I would say as you're running your businesses, use this opportunity to really think about what your customers want and need, and then design your systems to deliver that. I think it's Brene Brown who once said, companies never rise to the height of their greatest aspirations. They sink to the bottom of their most broken systems. And so putting the right processes and systems in place to deliver value to your customers is also important. And during the pandemic, that was one of the things we did. We really focused on our quality systems because we knew we had an opportunity to get better there, and we seized that opportunity.
And during this time period over the last 3 years, a lot of people have shifted with technology. So talk a little bit about how your company shifted and used technology, and what has been the best technology enhancement that you've seen so far?
Yeah, for me, because I'm an assembler, and so I put together, what you would call dashboards, we call them instrument panels. I put together center consoles that are inside the vehicle. So as an assembler who's backward integrated into injection molding, the thing that I've been most proud of, and we've done a number of things over the last 3 years, but we've put in some world-class vision systems that, an operator can only be about 80% effective in terms of finding defects. These vision systems, as they are trained, are perfect in terms of finding where things are misplaced or misassembled, or if there's any sort of scuffs or scratches. And us bringing that technology on during the pandemic, and now here we are, 2.5, 3 years later, it has really paid dividends for us in terms of being able to help us produce higher quality parts. The other things we've done are we've improved our ability to test for electrical connections or misconnections, which significantly helps our customers as well. So for us, it's been investing in process technology that is world-class and solving age-old problems through using computers and artificial intelligence and vision systems and cameras that frankly weren't available, 20 years ago. Today are.
And what are 3 things that you would tell, that you actually help your employees and your company? What are 3 things that you do each day to make sure that everyone succeeds?
The 3 things I practice this religiously every day. 1, making sure that anybody I come in contact with or communicate with via email, whether it's in person, is I care about you. How are you doing? Let's start there. Secondly, what are you working on and how can I help? Which is a tenet of servant leadership. And then thirdly, I spend some time each day thinking about where we want this company to be 5 to 10 years from now. And are we doing the right things today to get us there? Whether that's the right systems, the right structure, the right strategy, and do we have the right people in place to help us achieve where our dreams are?
And let's branch a little bit off of servant leadership. I know you mentioned earlier that you help support employees to reach their dreams. Like you said, they want to become a barber. So how are you helping people in your company each day and also the community?
Okay. At its foundation, where I'm located, which is the Gateway Industrial Plaza, which is on the west side of Detroit, we're in what I call underserved neighborhood, which is why we were able to get at the outset of this business. I acquired my shares in 2018, but in 2012, when the company was launched, we were able to get new market tax credits. And it's my understanding the number of jobs that were added in this facility at that time were the single largest additional jobs in the city of Detroit since the 1970s. And so employing people from an underserved area and giving them a place where they're cared for and are well paid. I love that we're giving people first and foremost an economic opportunity to do better for themselves and their families. Second thing is we provide for educational opportunities. I talked about that earlier. I think those 2 things both represent escape velocity from poverty or to get yourself into the middle class and then into the upper class. And the third thing we do is we have a bias towards promoting from within. And so over the last 5 years, we've had upwards of 100+ promotions that we've done internally. So I've had stories of people who were operators that are now in management, and their salaries over that point in time have gone up considerably, much faster than the inflation rates that we saw. And so through those 3 things, we've really done a good job of getting people a platform to do well for themselves. Regarding the community, which was the other question, we do all the typical things that large employers do. Charitable contributions. Some of my key executives sit on the board of directors of a couple of nonprofit foundations. But the thing that we've done is, I think most unique is we've created 16 houses inside our company. So think of Harry Potter, right? When they have the house system. And each of those houses has roughly 20 people in there that represent all of my salaried employees. And each of those houses has a budget that they are designated to spend with a charity of their choice. But they just can't send the money. They also have to send people to go provide man hours or woman hours with that charity. What that does is completes that eco cycle of us really being true to our values. In fact, I had an employee about 3 weeks ago who sent me an unsolicited email saying, not only do we speak about our values, here we're living our values. And I'm really thrilled that I get to participate in helping to do something for a local charity, not just by knowing my company sent dollars, but that I personally had an opportunity to go work. And I believe this person went to a food bank where we served the homeless that day. So through our housing mechanism, our houses, if you will, we're also reaching out and touching the community that way, which I think is unique.
And how have you seen the business scale? I don't know if you knew about the company back when it started in 2012, but you know, what is the journey like to scale your business up to becoming mid-sized, large scale?
Yeah, it's a fun journey, but as some of the panelists have talked about earlier, with the labor shortages in the marketplace, we're having conversations internally around, should we be looking for a new location soon? Because maybe we've tapped out sort of the market within where we are and their ability, you know, within our commuting range. Don't have the answer to that yet, but we're talking about it. And so for us, we think we can grow at a compound annual growth rate of about 8%, but that's betting on the labor market cooling off a bit so that we can have access to talent and driving automation into our process so that we can, you know, increase our productivity and we're not reliant upon people who aren't looking for a job, that we would love for them to be looking for a job. And so the growth challenge has been one that we're embracing and we're excited about. But we're also going to be very deliberate to make sure we're not growth junkies, we're just growing for the sake of growth. And we're picking the right projects with the right customers, and we're sure that we can support it.
And I just want to make sure that we include the audience question before I ask my last question.
Okay, any questions from the audience?
Yes, we do. Let's see here. Chanel, this is for you. In your role as a business reporter, what is the best way to share business-focused news content to business or lifestyle reporters?
So first I would look at the type of business that you have and look at your story. And then I would go to Google and search for, you know, whatever specific news outlet that you might want to work with and look at the staff page and look at it and find like who the person is that would be reporting about your story. So I'm a small business reporter at the Detroit Free Press, and I focus specifically on minority-owned businesses. So if that's who you're looking for, then you would search for me. If you're looking for another news outlet, like you would go about that way and search for them. But you know, just like really searching on Google to find who we are, and also finding us on social media. A lot of us are very active on there, and just shoot me a DM and tell me your story. And I'm always open to listening, and so is everyone else in the industry.
Okay, thank you, Chanel. And this question, final question, is for Bruce. Is DMS hiring post-pandemic? And if so, what type of jobs and how are they sourcing? How are you sourcing for potential employees?
If the answer is yes, we are. And if you go to our website, dmsna.com, so D like dog, M like Mary, S like Sam, N like neighbor, A like Apple, dmsna.com. And if you go to the careers tab, you can contact us and we'll be sure someone will reach back out to you. But we're hiring all the way from hourly jobs in our supply chain group, which is really moving materials through our facility, to the production jobs that are on the assembly lines or in our injection molding department. We've got 33 presses that go up to 2,500 tons. So we have a large injection molding presence. And then we're also hiring in select salary positions. So I know we're looking for quality engineers. We're looking for people who have expertise in supply chain. We're also looking for interns. So I just sat and had lunch yesterday with about 15 interns that are working at our company, coming from Kettering University to Michigan Dearborn campus, to Michigan State. And so if you know someone who's an intern who's looking for a co-op program or an internship, send them my way as well.
Now I have another question. So, talking about the interns, what does the workforce look like today? Like, what do you see promising from the students coming out of school today?
Yeah, millennials get a bad rap. The word on the street with millennials is, you show up one day, you work till lunch, and you go, where's my raise and where's my promotion? I love the millennials. They're aggressive, they're smart, they're the best networkers we've ever seen. They don't operate from a basis of fear. They have an attitude of, look, you're gonna give me what I want as an employer, I will get employed somewhere else. And I love the challenge that gives me and my management team, because it gives us an opportunity to think about what is work and how do we give these folks interesting projects. There was a study done years ago by, I think it was MIT, Carnegie Mellon, and the University of Cambridge. They were asking the question and did a bunch of research around what really motivates people. And what they found is that money, once you pay people a fair wage, money is no longer a motivator. And all of us have gotten raises and you're excited for a week and then the next thing you know, the thrill of that raise is gone. So the three things were really connecting to a larger purpose. We believe in our value system and the way that we treat people and the way that we have this desire to help everyone around us as a beacon that attracts and retains folks, and our numbers support that. Secondly, is people love autonomy. And not just autonomy in terms of leave me alone, let me do what I want to do, but autonomy in terms of, we have a phrase internally where we go, when you come to DMS, you belong. And our definition of belonging is you don't have to portray who you are to fit in, you come as you are. And so that autonomy, and then thirdly is self-mastery. When people are interested in something, they want to be supported. And so we're big on, if you want to learn something, we'll help you learn it and we'll be supportive. So if you think about that as motivation, the millennials represent that in my mind really well, and they aren't bashful about speaking up and articulating that. And so we're not bashful in terms of how we respond and giving our best effort to accommodate them. So connecting with them emotionally, but also giving them meaningful work that they can connect to their value stream is also important.
And any parting thoughts that you want to leave with our attendees today?
Dream like you're gonna live forever and live like you're gonna die tomorrow. Give it your all and help everybody around you and be a servant leader as well.
I have one question. I had to read the room permit. Maybe ask the question, I'm not sure if you did, about ghosting. Did you guys talk about that?
About ghosting, you brought up ghosting earlier.
Yeah, and that was a question, obviously, for that from Tom's presentation and the panel discussion. How is DMS handling that particular issue when we as relates to employees?
Yeah, it's hard to plan for ghosting. Based on the name itself, it means you didn't realize it was about to happen until it happens. From our perspective, we go, look, we understand we invested a lot of time and energy into you to get to the point to where we made you an offer. But the fact that you ghosted us also saved us a lot of time, money, and energy, because for whatever reason, you self-selected out. And we're not just looking for people that can do the work that we want them to do. We're looking for people who believe in what we believe in. And if our value proposition and our culture wasn't enough to really pull you in, then you probably weren't for us. At the same time, we're reflective and, we reach out to those who ghost us, but by the nature of ghosting, they don't always respond. But we're inquisitive around what was it about us that you decided not to come. And we get most of that information from people who have left in their exit interview. And we use that to continue to get better.
Outstanding. Well, I want to take this opportunity to thank both Chanel Stiff from Detroit Free Press. Again, I encourage you to read her stories. She writes phenomenal work. She's a wonderful paper. I also encourage you to reach out to DMS, give me the website again.
DMSNA.com.
There it is. It's in the chat room and you look for opportunities. Go check out the website. Bruce is a phenomenal servant leader.
And we are dedicated, we believe everybody deserves a great boss. So if your boss stinks, call me.
So what we're going to do, let's begin. Are there any more questions before we take a break? Any more questions?
No, there aren't any more questions.
All right, so what we're going to do is to take a quick break and we're going to show you a brief video from Comcast as it relates to the Comcast Rise program. We will start back at 10:30 and we will have individual workshops with individual leaders starting with, I believe, at Fifth Third Bank. So we'll see you in 15 minutes after this video.
All right, thank you.
I think a lot about my mom and how she thought about her business, not just about what her receipts were for that day. Who is she going to hire? Who is she going to help in the community? We're focused on underrepresented entrepreneurs, in particular, entrepreneurs that don't always have access to capital. And for us, it was about advancing equity, period. I mean, that's creating an incredible foundation for wealth building, and just really proud that we're doing it here at Comcast.
Good comment, thank you for that. I mean, so from the $1 billion business to the $100,000 business, some of the same.
Same issue.
Exactly. Now, Gateway.